Welcome to the Bank of England Youth Forum podcast on digital currencies, where we're taking a look at cryptocurrencies and trying to educate the youth of Britain, as well as the average person in general, about cryptocurrencies, what they are, and details about what CBDCs are, and sustainability and various other topics related to it. So today we have a very special guest with us. We have Enrico Rossi, and I'll just hand over to him to introduce himself.
Thank you very much, Jack, and thank you, Arnaud, for inviting me. Yes, I am a research fellow at UCL Computer Science Department. I'm an associate fellow as well to the UCL Centre for Blockchain Technology, and I'm visiting at LSE Management Department. And I've been really researching and teaching about cryptocurrencies for 5-6 years already. I lecture on cryptocurrencies at UCL, and I've been setting up one of the first courses actually at LSE, online executive courses on crypto assets. So this is pretty much me.
Awesome. And Enrico, starting right into the topic, there's a question that many listeners would have, which would be, when was the first cryptocurrency created? And maybe in a sense also, why was it created?
Yeah, sure. I mean, this is a very interesting and in a sense trivial but also complicated question, because obviously the first cryptocurrency, as many of you probably knows, was Bitcoin, which was actually basically went live in January 2009. The Genesis block of the Bitcoin, first Bitcoin client is January 2009. That's the first transaction. The white paper was written in 2008. So Bitcoin can be considered the first cryptocurrencies. And soon after, there were other cryptocurrencies that follow, such as Litecoin, Ripple in 2013, and then eventually Ethereum went live in 2015. So these are the main cryptocurrencies that many of you also know. However, I think it's always important to understand the precursor in a sense of Bitcoin, right? Because Bitcoin didn't really come out of the blue. And it was actually the end result of a slow process that actually started in the 80s. And so there are at least two main precursors of Bitcoin that has to be taken into consideration. One is DigiCash, which was actually founded in 1989 by David Chaum, which was a cryptographer, from which the whole encryption and cryptographic thing of cryptocurrencies is coming from. That was the first digital e-money, which was actually using a very similar technology to Bitcoin, which is the double private and public keys encryption, which was actually shut down in 1998. But then there was a second precursor, which was eGold, which was slightly different from DigiCash. It was not anonymous as DigiCash was, but the whole point of eGold was actually to make sure that you can transact value, which could be stable across addresses on the internet. So in a sense, eGold in 1996 was a first very early precursor of current stable coins, in a sense. And this was also shut down actually by the Department of Justice around 2007. But these are two important precursors, right? Because DigiGold shows us the necessity of having some way to transact stable value online on the internet in the 90s. And DigiCash actually shows us already by the end of the 80s how cryptographers want to use encryption algorithms to actually make anonymous or pseudonymous transactions online, right? And so Bitcoin can, in a sense, be seen as the end product of something which is a merge, or a conflation of these two precursors in 2009. Pseudonymity plus encryption. So that is really where Bitcoin is coming from. And there is a third actually precursor, which I always like to mention, which is Napster and BitTorrent or Renewal, which are nothing to do with money and value, but they actually provided design and the architecture of cryptocurrencies, which is a peer-to-peer architecture that enables distributed nodes to actually share files and share data and transact data in a peer-to-peer manner. Actually, Napster, which I think was closed in 2001, was not completely peer-to-peer because it has a central repository. But the technologies that came up after Napster, such as BitTorrent, they were actually peer-to-peer. So the way in which I like to frame the origin of Bitcoin in 2009 is to bring the peer-to-peer technologies of the 90s for file sharing, the first DigiCash that used encryption to, having anonymous payments, and then the intuition of ego that actually focused on, transaction of stable values across address. You put everything together. These are all developed, were all developed in the 90s, really, very late 80s, early 90s. And then you can understand, in a sense, the separate efforts that have been developed in order to come up with Bitcoin in 2008, 2009. And then from there, many other cryptocurrencies, very few cryptocurrencies until 2013, 2014.
That's very interesting. And I noted there that you made a few points on technology, talked about peer-to-peer as well as, the blockchain element of it. So I guess the next question is, what are the technologies behind cryptocurrencies and how does something like Bitcoin work?
Yeah, absolutely. I mean, this could potentially be a very complicated topic, right? So let's make it quite simple and accessible. So the whole point of Bitcoin is decentralization, right? So what everyone says, decentralization, which is a very complicated term. So in order to understand the technology behind Bitcoin, we have to understand that the whole technology was developed somehow in order to reproduce some form of decentralized exchange of value, right? So, or how the Bitcoin white paper says, peer-to-peer digital cash system, okay? So the technology behind Bitcoin is a technology that makes sure that the peer-to-peer, as we were saying, transaction between two nodes shouldn't be validated or settled by a central node, but it should rather be validated and settled by a protocol. And the characteristic of this protocol is actually decentralization, which in this case means that, at least in theory, at least in its original intent, the Bitcoin protocol could be run by any node. So this is what we usually call a consensus layer of the technology. So any node could actually run a program that, by solving a hash function, which is a very technical term, but let's say, a puzzle, could actually verify whether a transaction is valid or not. The point here is that with Bitcoin, we want to reproduce the exchange of a banknote between two people, right? So the exchange of a banknote doesn't really pass through an intermediary because it's me giving you a banknote to you, right? So the technology had to come up with some solution to actually make sure that this transactional value could be enforced anonymously and equally by the network itself rather than by a special actor. And this is why, rather than introducing an intermediary, there is this logical layer in the blockchain stack, which is the consensus protocol. And the consensus protocol is a specific mathematical algorithm, encryption algorithm, that could originally be run by everyone. And once that someone finds the solution to this puzzle, which is not a trivial solution, actually the solution becomes harder and harder as the network grows, and as the capacity to solve the solution grows, it automatically becomes harder. So as this happens, there are fewer and fewer nodes that actually will be able to address this, but anyone can verify the solution. So the trick here is to make a consensus protocol that makes extremely hard to verify whether a transaction is correct, because it has to maintain, pseudonymity and encryption. However, once that someone verifies the transaction, the settlement becomes extremely easy because anyone can actually double check that the actual transactions, once they are added to a block, are correct. And this is due to the properties of the hash function, which are mathematical properties, which allow for this, right? So really the technology behind Bitcoin is, I've got a consensus protocol, which is decentralized. Potentially anyone can run it. Once that a transaction is validated, is added in a block, anyone can actually see the encrypted or hashed transactions on its computer, right? So there is a decentralization in terms of who solves the problem and who accepts the transactions. But there is also a decentralization one layer above that, which mainly involves who can see the transaction, right? Who can access the ledger and the data with respect to the transactions, one that they are added to the network. And even this technically is decentralized in the sense that potentially anyone can see the history of transactions. Obviously, these are encrypted hash transactions, so you cannot see the content, you cannot see the identity of the guys, but anyone can see, right? So that's, in a very generic, a very high level base, this is how standard Bitcoin transaction, but even others really work. And the essence there is really the hash function that is used to encrypt this and to make sure that the consensus can be done in a decentralized manner without revealing identities and content of transactions. So that's pretty much the essence.